While most of the market is fixated on gold's record-breaking price, the real story isn't the number itself. It's who is buying and, more importantly, why. There's a huge structural shift happening under the surface, and Goldman Sachs just put a massive new number on it, a number that suggests this rally has a long, long way to go. So, let's break down exactly what they're saying.
To put this all into perspective, gold just ripped 65% higher in 2025, and it didn't stop there, tacking on another 12% in just the first few weeks of 2026. For the big institutional players, the conversation has totally changed. It's no longer about if we'll see new records, it's about finding the ultimate ceiling for this bull market.
And that brings us right here. Goldman Sachs has just dramatically raised its price target for the end of 2026. They've gone from an already bullish $4,900 all the way up to $5,400. Look, this isn't just some minor adjustment. This is a massive signal of institutional conviction. And right now, we're going to deconstruct exactly what is driving that conviction.
So here's our game plan. First, we'll look at the why behind the forecast. Then, we'll dig into the 3 core drivers pushing it higher. After that, we'll map out the key technical levels you need to watch. And finally, we'll wrap up by looking at the 3 big risks that could throw a wrench in this whole thing.
Okay, let's dive right into the forecast itself. What's the fundamental logic? Why would a major investment bank make such a significant upgrade right now?
Well, the bank is pretty explicit about it. They're saying this isn't about short-term speculation or market hype. No, this forecast is built on a deep structural shift in who is buying gold. We're talking about 2 massive sources: private sector investors looking for a hedge, and this is the big one, emerging market central banks strategically moving their reserves away from the dollar.
So what are the powerful forces creating this super bullish environment? Let's deconstruct the 3 core drivers right now.
This whole rally is really being fueled by 3 big overlapping forces. First, you've got that persistent structural demand from the big players. Second, a huge pivot in monetary policy. And third, the pure technical momentum that just sucks more and more capital into the trend.
So, what do we actually mean by structural demand? We are not talking about day traders here. This is consistent strategic buying from the giants. We're talking central banks, massive institutional funds. They're using gold as a long-term hedge against all the economic and policy risks out there in the world.
And we can actually put a number on that demand. The model assumes that emerging market central banks alone are going to keep buying gold at a pace of about 60 tons every single month through 2026. This kind of consistent, huge buying is a powerful force that tightens up the physical market and basically builds a solid floor under the price.
Now, the second major driver is all about monetary policy. The market expects the U.S. Federal Reserve to start cutting interest rates, and when that happens, the opportunity cost of holding a non-yielding asset like gold, well, it goes way down. This is the trigger that's expected to unleash a whole new wave of buying from Western investors through gold-backed ETFs, which, believe it or not, have been pretty quiet until now. By the way, if you're finding this explainer helpful, do me a quick favor and hit those like, share, and subscribe buttons. It really helps us out, and it ensures you won't miss any of our future content.
So we have the fundamental drivers locked in. But how does the price chart itself back up this bullish story? Well, the analysis points to a very, very clear technical structure.
The core idea here is to think of the uptrend like a ladder. Each rung is a technical price floor, a line in the sand drawn by the market. And as long as the price stays above these key rungs, the bullish structure is considered totally intact.
The first rung on that ladder is right around 46.50. This level corresponds to a recent price gap you can see on the charts, and it basically represents the market's first line of defense against any minor pullbacks.
But this is the really crucial level to watch, 43.60. This price zone lines up with the 50-day moving average, and it's considered the primary defense line for this entire move up. A sustained break below this would be a major red flag that a much bigger correction could be coming.
And finally, we have the ultimate long-term boundary, the 200-day moving average. Right now, it's near $3,800. This is the classic technical line that separates a long-term bull market from a bear market. The fact that the price is so far above it just highlights the incredible strength of this trend.
Now, for a balanced analysis, we have to talk about what could go wrong. The entire bullish case we've just laid out depends on a few key assumptions holding true. If those assumptions fail, well, the forecast fails right along with them.
So, here are the 3 core risks you need to keep on your radar. First, what if that structural buying from central banks suddenly stops or reverses? Second, what if the Fed gives us a hawkish surprise?
meaning they get tough on inflation and either delay cuts or, even worse, hint at more hikes. And third, a clean technical breakdown below that primary support level we just talked about at 43.60. These are the variables to watch.
And that leaves us with one final critical question. We've laid out the bullish case and its key drivers. We've also identified the exact risks that could derail it. So I'll leave you with this to think about. In today's incredibly complex macro environment, which of these three potential threats do you think is most likely to show up first?